In this lecture, we are going to explain the stock market, and we're going to show how to invest in stocks through common stock and preferred stock. Also, we are going to explain how stocks are sold through first organized securities exchange, second over-the-counter markets, and finally alternative trading systems and multilateral trading facilities. Investing in stocks. A share of stock in a firm represents ownership. A stockholder owns a percentage interest in a firm, consistent with the percentage of outstanding stock held. Also, investors can earn a return from stock in one of two ways. Either the price of the stock rises over time, or the firm pays the stockholder dividends. Note that frequently investors earn a return from both sources. Also, a stock is riskier than bonds because stockholders have a lower priority than bondholders when the firm is in trouble. Dividends are less assured, and stock price increases are not guaranteed. Despite these risks, it is possible to make a great deal of money by investing in stock, whereas that is very unlikely by investing in bonds. Another distinction between stock and bonds is that stock doesn't mature. Also, the ownership of stock gives the stockholder certain rights regarding the firm. First, the right of a residual claimant, which is stockholders have a claim on all assets and income left over after all other claimants have been satisfied. If nothing is left over, they get nothing. Second, the right to vote for directors and on certain issues such as amendments to the corporate charter and whether new shares should be issued. Note that the stock certificate shown in the following figure doesn't list a maturity date, face value, or an interest rate. Common stock versus preferred stock. There are two types of stock, common and preferred. Let us begin with common stock. A share of common stock in a firm represents an ownership interest in that firm. Also, common stockholders vote, receive dividends, and hope that the price of their stock will rise. There are various classes of common stock, usually denoted Type A and Type B, and so on. The differences among the types usually involve either distribution of dividends or voting rights. Preferred stock is a form of equity from a legal and tax standpoint, and it differs from common stock in several important ways. First, because preferred stockholders receive a fixed dividend that never changes, a share of preferred stock is as much like a bond as it's like common stock. Second, because the dividend doesn't change, the price of preferred stock is relatively stable. Third, preferred stockholders don't usually vote unless the firm has failed to pay the promised dividend. Fourth, preferred stockholders hold a claim on assets that has priority over the claims of common shareholders, but after that of creditors such as bondholders. How stocks are sold. We originally discussed stocks as trading either on an organized exchange or over the counter. Recently, this distinction is blurring as electronic trading grows in both volume and influence. Organized securities exchanges. The traditional definition of an organized exchange is that there is a specified location where buyers and sellers meet on a regular basis to trade securities. Examples of major organized stock exchanges around the world are the Nikkei in Tokyo, the London Stock Exchange in England, the DAX in Germany, and the Toronto Stock Exchange in Canada. To have a stock listed for trading on one of the organized exchanges, a firm must fill an application and meet certain criteria set by the exchange designed to enhance trading. Over-the-counter markets. Securities not listed on one of the exchanges trade in the over-the-counter market. This market is not organized in the sense of having a building where trading takes place. Instead, trading occurs over sophisticated telecommunications networks. One such network is called the National Association of Securities Dealers Automated Quotation System, shortly NASDAQ. Alternative trading systems and multilateral trading facilities. Alternative trading systems are trading systems that bypass traditional exchanges and allow for buyers and sellers of securities to deal directly with each other. Alternative trading systems and multilateral trading facilities are typically used for large transactions among institutional investors. A subset of these trading facilities consists of electronic communications networks, which are alternative trading systems that are fully electronic. An electronic communications network is an electronic network that brings together major brokerages and traders so that they can trade among themselves and bypass the middleman. Electronic communications networks have a number of advantages that have led to their rapid growth. First, transparency. All unfilled orders are available for review by electronic communication network traders. This provides valuable information about supply and demand that traders can use to set their strategy. Although some exchanges make this information available, it is not always as current or complete as what the electronic communications network provides. Second, cost reduction. Because the middleman and the commission are cut out of the deal, transaction costs can be lower for trades executed over an electronic communication network. Third, faster execution. Since electronic communication networks are fully automated, trades are matched and confirmed faster than can be done when there is human involvement. For many traders, this is not of great significance, but for those trying to trade on small price fluctuations, this is critical. Fourth, after hours trading. Prior to the advent of electronic communications networks, only institutional traders had access to trading securities after the exchanges had closed for the day. Many news reports and information become available after the major exchanges have closed, and small investors were locked out of trading on this data. Since electronic communications networks never close, trading can continue around the clock. Note that, along with the advantages of electronic communications networks, there are disadvantages also. The primary one is that they work when only for stocks with substantial volume. Since electronic communications networks require there to be a seller to match against each buyer and vice versa, thinly traded stocks may go long intervals without trading.